Hi, I'm John Fitzgerald and welcome to this week's edition of Team Wealth Builders. If you study the real estate market and real estate cycles, it really is a study in the flow of money, because booms and busts are actually caused by banks and the flow of money coming and going. And if I study back to the major booms we had in the 70s, the 80s, the 90s, 2000, etc., it all coincided with a lot of new funds coming into Australia, overseas banks setting up. And I remember in the 80s there were 28 different banks that had set up shop here in Australia doing deals with developments and commercial deals, commercial operations, all of that, syndicated deals. And that's what drove the boom in the 80s, which was massive. And we had a lot of Japanese investment as well. Now, the 90s, similar sort of thing, driven a lot by America and a lot by the ability for the American banks to raise funds, loan money into Australia. The GFC was the opposite of that. The banks ran out of money. So I've got some figures quoted at one stage. We had $7 trillion in the system in Australia, reduced to $1.5 trillion of available loans or lending. That's a massive reduction. And that's why stopped lending on construction and development, business had trouble getting loans, etc., etc., etc. Now, I look at the flow of money and there's been a major change in the last 2 to 3 months. And the major change is, for the first time since the GFC, Australian banks have now been able to access money from overseas, and particularly from the American banks, Japanese banks, and some other banks that are entering Australia as well. That is Chinese banks and Indian banks, and many new banking licenses that have been issued. And in fact, in Sydney, Melbourne and Perth, ICBC Bank of China have got 70 branches that they're setting up. So these are significant changes. But let me get back to the bigger picture. We had around $1.5 trillion reduced to the loan flow because we couldn't get money from overseas. Now we're getting money from overseas. The cash rate today in Australia is 3.25%. The banks are happy to get as much money as they can at 3.25% and then loan it out, particularly on commercial loans, where they might get 6 or 7%, 5.5%, 6 or 7% return. That's good business for them. Previously, they weren't able to access the money. Now they are. Why are they able to access the money, and where's the money coming from? It's coming from America, it's coming from Europe, and it's coming from Japan and Asia as well. Why? Well, because of our interest rates. Because our interest rates are pretty much the highest in the Western world for a stable, in fact, a really well-performing economy as we have. The US, Europe, Japan, lots of other areas have 0 to 1% interest rates. That is, if you put your money in the bank, you get 0%. So wealthy investors would think, well, I could buy Australian bonds and get 3.5%, and even if the Reserve Bank reduces the cash rate to 2.5%, I'm still double or 2.5 times better off than I am at home, and Australia is a strong economy. Now, the banks can also access this money for the first time. And they can because America's doing pretty well. America did a smart thing. They devalued their dollar. And what that's done is it's caused an uplift in their agriculture and an uplift in manufacturing. Their unemployment's come down significantly from 11-point-something% to the 7s now. Their housing construction are back up to 800,000 house starts a year. Now, these are significant turnarounds. And their banks last year, that is all the American banks, made $110 billion. What does this all mean to Australia? Well, now we have lowering interest rates. We have more money coming in. So investors are going to get less on their deposits, and they've gone from 5%, 4.8%, 5%, to now they're getting 3-point-something%, and that could even go lower. Those people, therefore, have had their incomes cut in half. They're going to be looking for options, and particularly when they can get real estate returning nearly 6%. Now think about that, because all that's going to do is change the dynamic where we're going to have that demand in the market, and it's already happening. There's the numbers on it. We've had real estate growth in the June quarter and in the September quarter, and we've had so much more action in those quarters with clearance rates in the major cities up by more than 20%. Why? The flow of money. Thanks for listening to me.